Ladies and gentlemen, let me start with a question that should make every one of us sit up straight. What if the smartest money in the world is quietly moving and you're not invited to the meeting? While most people are busy chasing headlines, scrolling markets, and arguing about tomorrow's prices, something extraordinary has already happened. A staggering $4 trillion has flowed into gold. Not loudly, not emotionally, but deliberately. And whenever money moves in silence, it's worth asking why. Here's the truth about economics that no textbook teaches you clearly enough. Money doesn't react, it anticipates. Big institutions, central banks, and long-term investors don't wait for crisis to appear on the news. They position themselves before uncertainty becomes obvious. Gold has always been more than a metal, it's a signal. It's a vote of no confidence in instability, excessive debt, and fragile systems. When trillions move into gold, it's not about fear, it's about foresight. Think about the world we're living in right now. Rising inflation, growing government debt, geopolitical tension, currency volatility, and economies built on promises instead of productivity. Paper assets can be printed, digital numbers can be inflated, but gold cannot be created by policy, by tweets, or by wishful thinking. For thousands of years, through empires rising and falling, gold has held one message constant: real value survives chaos. That's why when confidence in systems weakens, confidence in gold strengthens. Now here's the hook most people miss. This shift isn't just about gold, it's about mindset. The wealthy and powerful don't ask, what's popular right now? They ask, what will protect value over time? They understand cycles. They understand that booms don't last forever, and neither do illusions of safety. Gold becomes the quiet shelter when storms are being built behind the scenes. It's not about getting rich quick, it's about not getting wiped out slowly. And this is where it becomes personal. Because economics isn't just charts and numbers, it's choices. It's awareness. It's the difference between reacting late and preparing early. The real gap between those who struggle and those who endure isn't intelligence, it's perspective. When you start paying attention to where serious money goes, you stop chasing noise and start building resilience. You stop asking, what should I buy today? And start asking, what will still matter tomorrow? Capital never waits for permission, and it never asks for reassurance. In economics, the most revealing signals appear long before a crisis makes headlines. When $4 trillion quietly relocates into gold, it is not an emotional reaction to fear. It is a calculated response to expectations. Smart money moves ahead of uncertainty, not behind it. History shows this pattern repeatedly. Markets whisper before they scream, and capital listens closely to those whispers. Consider how major financial institutions, sovereign funds, and central banks operate. Their decisions are driven by probability, not prediction. They do not attempt to guess the exact timing of a downturn. Instead, they position themselves where risk is minimized if multiple negative outcomes occur. This is where gold becomes strategically important. It represents a preemptive shift toward stability when economic signals begin to weaken, rising debt levels, overstretched valuations, tightening liquidity, and geopolitical fragility. These are not sudden developments, they are slow, building pressures that informed investors recognize early. The critical insight here is that capital flow itself is information. When trillions move, they reveal collective expectations about future conditions. In economics, this is known as anticipatory behavior, markets pricing in risk before it becomes visible to the broader public. Retail investors often react to events. Institutional capital prepares for them. That difference in timing creates the difference in outcomes. By the time uncertainty becomes obvious, positioning opportunities have already narrowed. Gold's role in this movement is especially telling. It does not generate yield, promise growth, or rely on optimism. Its value lies in independence from policy decisions, corporate performance, and political cycles. When capital shifts toward an asset with no counterparty risk, it suggests a rising preference for certainty over speculation. This is not a bet against growth, it is insurance against disruption. And insurance is always purchased before the accident, never after. The real hook is this: crises rarely announce themselves clearly at the start. They begin as imbalances, small, ignorable, and inconvenient to acknowledge. Those who control large pools of capital cannot afford denial. Their early moves often look boring or unnecessary in the moment, but they appear obvious in hindsight. The $4 trillion move into gold is one of those moments. It reflects a silent consensus that the global economic environment is shifting, and when capital starts preparing quietly, It is already telling you that the future will not reward complacency. Gold's economic relevance begins with a simple but powerful constraint: it is finite. Unlike fiat currencies, which can be expanded at the discretion of central banks, gold exists independently of policy decisions, political pressure, or short-term economic objectives. This scarcity is not theoretical, it is physical, measurable, and resistant to manipulation. Every ounce ever mined still exists today, and annual production increases only marginally. That limitation alone gives gold a unique credibility in preserving value across time. In periods of inflation, the purchasing power of money quietly erodes. Prices rise not because goods suddenly become more valuable, but because currency becomes less scarce. This is where gold historically asserts its role. It does not inflate alongside money supply. Instead, it reflects the declining value of currency itself. Economically, gold acts as a mirror. When currencies weaken, gold does not suddenly become more valuable. It simply reveals what paper money has lost. That distinction matters, especially when inflation is gradual and politically downplayed. Another critical dimension is trust. Fiat currency functions because of confidence in governments, central banks, and economic management. When that confidence is strong, currency performs efficiently. When it weakens, alternatives gain attention. Gold requires no promise, no issuer, and no enforcement mechanism. Its value is not based on faith in an institution, but on universal acceptance developed over thousands of years. That level of trust cannot be legislated or printed. It must be earned through consistency. And gold has already done that work. The hook most people overlook is that gold does not compete with productive assets. It complements them. Economically, it serves as a stabilizing anchor in environments where volatility distorts pricing signals. During periods of monetary expansion, negative real interest rates, or currency debasement, traditional savings vehicles can fail to protect purchasing power. Gold fills that gap by existing outside the credit system entirely. It has no default risk, no maturity date, and no dependency on growth assumptions. What makes gold especially compelling in modern economics is its long-term neutrality. Empires have changed, currencies have collapsed, and financial systems have been redesigned, yet gold has consistently retained its role as a reference point for value. This persistence is not sentimental, it is functional. When the future becomes harder to model and economic forecasts grow less reliable, assets that preserve value without requiring precise predictions become strategically valuable. Gold's enduring relevance is not about nostalgia, it is about mathematical restraint in a world increasingly defined by financial excess. Modern monetary systems are built on confidence, and confidence is far more fragile than most people realize. Fiat currencies hold value because societies collectively agree to trust the institutions that issue and manage them. When that trust begins to erode quietly, gradually, almost invisibly, the effects do not show up overnight. They appear first in behavior, not in headlines. One of the clearest behavioral shifts is the movement away from paper assets and toward tangible stores of value. Over the past decade, governments across the world have accumulated unprecedented levels of debt. This debt is manageable only as long as interest rates remain controlled and economic growth remains cooperative. When either condition weakens, pressure builds within the system. Central banks often respond by expanding money supply, suppressing rates, or extending liquidity, all rational actions in isolation, but destabilizing when prolonged. The hook is this: the more intervention required to sustain confidence, the less organic that confidence becomes. Currency debasement rarely looks dramatic at first. It looks like stimulus. It looks like support. It looks like temporary measures that quietly become permanent. Over time, the purchasing power of money declines, savings lose strength, and long-term planning becomes harder. Individuals may feel this as higher living costs, but institutions read it as a structural signal. When the rules of money change too often, capital seeks refuge in assets that are governed by physics, not policy. Another layer of concern lies in global currency dominance. When reserve currencies are used aggressively in trade disputes, sanctions, or political leverage, neutral trust weakens. Countries and institutions begin questioning their exposure to systems they do not control. This is not ideology, it is risk management. Reducing dependence on any single monetary authority becomes a rational defensive move. Gold in this context serves as a politically neutral asset, accepted globally, owned directly, and insulated from diplomatic friction. The most compelling hook is that loss of confidence is rarely acknowledged openly by policymakers. Admitting fragility can accelerate it. Instead, reassurance becomes the dominant message, even as structural imbalances deepen. Capital, however, does not rely on reassurance. It responds to incentives and probabilities. When monetary systems require constant reinforcement to function smoothly, sophisticated investors interpret that as a signal not of collapse, but of vulnerability. This growing preference for hard assets reflects a deeper economic truth trust. Once stretched too far, seeks alternatives. Gold's resurgence is not an attack on modern finance, it is a response to its limitations. In an environment where monetary promises are increasingly complex and long-term certainty is harder to guarantee, capital gravitates toward what cannot be diluted, deferred, or redefined. Risk is never eliminated in economics, it is redistributed. The central objective of any serious investment strategy is not to avoid uncertainty, but to survive it. This is where diversification moves from theory into discipline. When assets respond differently to the same economic shock, portfolios gain resilience. Gold's economic value lies precisely in this non-correlated behavior. It does not move in lockstep with equities, bonds, or currencies, and that independence becomes critical when traditional markets falter simultaneously. Financial history offers a clear pattern. During periods of market stress, recessions, inflationary spikes, geopolitical shocks, correlations between risk assets tend to rise. Stocks fall together, credit tightens together, and even supposedly safe assets can move in unexpected ways. This phenomenon, often described as correlation convergence, exposes the illusion of diversification within paper markets. The hook is this: diversification across similar assets is not diversification at all. When confidence breaks, what matters is exposure to something fundamentally different. Gold occupies that different category. It is not a claim on earnings, a promise of repayment, or a derivative of economic growth. Its price behavior is influenced by macro conditions rather than corporate performance. As uncertainty increases, the demand for liquidity and safety rises, and gold often benefits from that shift. Economically, it acts as a counterbalance, absorbing pressure when risk-heavy assets lose stability. Another critical factor is volatility management. Large institutions are not judged solely by returns, but by drawdowns. A portfolio that grows quickly but collapses during stress fails its primary mandate. Gold helps smooth performance across cycles by reducing overall portfolio volatility. Even a modest allocation can significantly alter risk-adjusted returns. This is not speculation, it is portfolio mathematics. When an asset consistently behaves differently from others, it improves structural efficiency. The overlooked hook is that gold's role becomes most valuable precisely when it appears least exciting. During strong equity markets, gold may underperform and invite criticism, yet those are the periods when its insurance value is quietly accumulating. In economics, protection is always questioned until the moment it is needed. Institutions understand this trade-off. They are willing to sacrifice short-term excitement for long-term survivability. Gold's diversification role also extends beyond markets into regimes. Different economic environments, growth, inflation, deflation, crisis, reward different assets. Most portfolios are optimized for growth scenarios. Gold performs when that optimization fails. It is not designed to win every race, it is designed to prevent catastrophic loss. And in a world where financial shocks are faster, deeper, and more interconnected, that function is no longer optional, it is strategic. When central banks move, they do so with intention, patience, and an unusually long time horizon. They are not chasing quarterly performance or market sentiment. They are protecting national balance sheets and monetary credibility. In recent years, a noticeable increase in central bank gold purchases has sent a quiet but powerful signal. These institutions, which sit at the core of the global financial system, are deliberately diversifying away from over-reliance on dominant currencies and paper reserves. That behavior alone demands attention. Central banks understand something fundamental about risk that most participants overlook. Reserve assets are not about growth, they are about survival. Traditionally, foreign exchange reserves have been held in major currencies to facilitate trade and stabilize domestic economies. But when those currencies themselves are subject to inflation, political leverage, and expanding debt burdens, concentration risk emerges. The hook here is subtle but critical. What happens when the safest assets are no longer perceived as unquestionably safe? Gold offers a solution precisely because it exists outside the monetary authority of any single nation. It carries no credit risk, no counterparty exposure, and no dependency on policy alignment. When central banks increase gold holdings, They are not making a statement against a particular currency. They are reinforcing neutrality. In a fragmented geopolitical environment, neutrality becomes an asset. Gold cannot be sanctioned, frozen, or devalued through external decisions, which makes it uniquely attractive in an era of financial weaponization. Another layer of this strategy is credibility. A central bank's balance sheet is a reflection of confidence in its currency. Gold strengthens that confidence by anchoring reserves in something universally recognized and historically stable. This is especially important for emerging economies seeking to reduce vulnerability to external shocks. The presence of gold sends a message to markets. Stability is being reinforced, not assumed. The most compelling hook is that central banks are not reacting to a single event, they are adjusting to a changing global structure. Trade is becoming more regional, alliances more fluid, and financial systems more politicized. In this environment, dependence on a narrow set of reserve assets introduces strategic risk. Gold provides diversification at the sovereign level, much like it does within portfolios, but with far greater implications. When institutions with access to the deepest economic data and the longest historical memory choose to accumulate gold, they are revealing their priorities. They are preparing for a future where monetary flexibility matters less than monetary resilience. These moves are not dramatic, and they are rarely explained in headlines, but they are deliberate. And when central banks quietly change course, history suggests they are responding not to noise, but to structure. Economic cycles are not random events. They are recurring patterns shaped by human behavior, policy decisions, and capital flow. Expansion, peak, contraction, and recovery repeat with remarkable consistency, even though each cycle feels unique while it is unfolding. The challenge is that cycles are easiest to recognize in hindsight and hardest to respect in real time. This is where long-term thinking separates strategic actors from reactive ones. As economies mature within a cycle, growth becomes increasingly dependent on leverage rather than productivity. Debt expands faster than income, asset prices rise faster than fundamentals, and financial innovation accelerates to sustain momentum. These late cycle conditions often appear healthy on the surface. Employment is strong, markets are elevated, and confidence remains high. The hook lies in this contradiction. The most dangerous moments in economics often look the most comfortable. Long-term thinkers understand that returns are asymmetric across cycles. The goal is not to maximize gains at the peak, but to preserve capital through the transition. Gold historically gains relevance during these turning points, when uncertainty increases and traditional forecasting loses precision. It does not require growth to perform, it requires imbalance. As cycles stretch, the probability of policy intervention rises, and with it the risk of unintended consequences. Another overlooked dimension is time horizon mismatch. Governments and markets often operate on short timelines, elections, quarters, fiscal years. Economic cycles, however, unfold over decades. This mismatch leads to policies that smooth the present at the expense of the future. Inflation, currency dilution, and asset bubbles are not accidents, they are trade-offs. Gold becomes valuable in this context because it aligns with the longer cycle rather than the shorter one. It absorbs the cost of delayed consequences. The hook most people miss is that long-term thinking is not pessimistic, it is disciplined. It acknowledges that growth is powerful but temporary, and that preservation is what allows participation in the next expansion. Gold's role is not to outperform in every phase, but to remain relevant in all of them. It does not require precise timing, only patience. When capital begins shifting toward assets designed for endurance rather than acceleration, it signals a broader change in priorities. This shift reflects a collective awareness that the cycle is evolving. Those who understand this do not wait for confirmation in headlines or data revisions. They respect the rhythm of economics and position themselves accordingly, knowing that in every cycle, those who survive the transition are the ones who benefit most from what comes next. So let me leave you with this thought. The 4 trillion move into gold isn't a secret, it's a lesson. A lesson in patience. A lesson in protection. A lesson in thinking long-term in a short-term world. You don't need to panic, and you don't need to copy blindly, but you do need to pay attention. Because economics rewards those who prepare, not those who react. And when history looks back at moments like this, it never asks who was loud, it asks who was ready. Thank you.